So, have you ever wondered what really moves the stock market? I mean, it's not just the breaking news or some big CEO's latest tweet. There's this hidden rule, almost like a kind of financial gravity, that silently steers trillions of dollars around the globe. It decides which companies get a huge flood of investment and which ones get, well, left behind. And the crazy part is, most investors have never even heard of it. Today, we're going to pull back that curtain. Let's just dive right in with a puzzle. We all know Tesla, right? It's a giant with a market cap bouncing around $800 billion. But here's the thing. If you own a simple S&P 500 index fund, that huge number, it's not actually what's being used to weigh the stock in your portfolio. So what is going on here? Why isn't your investment fully reflecting the massive size of one of the biggest companies out there? And this really lays out the paradox perfectly. On one side, you've got that headline market cap. That's the total number of shares times the stock price. It's the huge number you always see on the news. But then, on the other side, you have its actual weight in an index fund, which is based on a much, much smaller figure. And that gap, well, that gap is the key to this whole story. So let's officially call this the Tesla valuation puzzle. We're going to figure out exactly why this gap exists. And in doing that, we are going to uncover one of the single most important and honestly most overlooked rules in all of modern finance. Okay, so the answer, the key that unlocks this entire mystery, comes down to two simple words: free float. It's this incredibly important difference between all the shares a company has and the shares that you or I or anyone else can actually go out and buy on the open market. Right, so what exactly are these free shares? That's what we need to get into next. Because, to really get your head around free float, you have to understand that in the eyes of the market, not all shares are created equal. Some are ready to be traded and, well, a whole lot of them are completely locked away. This table just breaks it down perfectly. On the left, you've got what's in the float. These are the investable shares, the ones held by everyday people like us, by mutual funds, by pension funds. These are the shares that are actually out there, available for trading. But on the right side, you've got what's out of the float, the locked up shares. We're talking about the huge stakes held by founders like Elon Musk, or by governments, or big private equity firms. Your index fund, it literally can't touch these. Now, the big index providers, they have a fancy technical term for this. It's called the investable weight factor, or IWF. But don't let the name intimidate you. Just think of it as a simple percentage. It's just the piece of the pie that's actually in that free float bucket, ready for the public to trade. And that number is what really determines a company's true weight in an index. Here's a super simple way to think about it. If a founder, let's stick with Elon Musk, owns 20% of Tesla, the market considers those shares locked up. So the company's IWF is 0.80 or 80%. What this means is that the trillions, and I mean trillions of dollars in passive index funds can only invest in that 80% of the company. They have to pretend that founders' 20% stake doesn't even exist. But here's the thing. The market hasn't always worked this way. Which brings us to our next section, the Great Index Shift. There was actually a time when indexes counted every single share, and it created a gigantic crisis that forced a complete rethink of how the entire market operates. Just take a look at this timeline. Back in the 70s, it was all about full cap. A company's weight was based on its total size. Super simple. But then we get to the late 90s, right in the middle of the dot-com bubble, and this created a massive problem. You had passive funds being forced to chase a tiny number of available shares for certain hot companies, which just blew up these huge price bubbles. The solution? Well, in the early 2000s, the big players like S&P and MSCI flipped the switch. The entire system moved to free float, and it changed everything. And this is just a perfect real-world example of the impact. When Tesla finally joined the S&P 500, passive funds had to go out and buy about $80 billion of its stock. But under the old full-cap system, they would have been forced to buy $100 billion. That extra $20 billion would have been scrambling for shares that were locked up by insiders. It would have created a huge artificial price surge. The free float rule was basically a crucial safety valve. So you see, this rule doesn't just affect one company here or there, like Tesla. It has this enormous, shaping influence on the entire global investment landscape. Let's call it passive gravity. Let's look at a really extreme case, Saudi Aramco. It's one of the most valuable companies on the planet. But as you can see here, the Saudi government owns a whopping 95% of it. That means its free float, the part that's actually available to global investors like you and me, is just this tiny, tiny 5% sliver. And here's exactly why that matters to you. Without this free float rule, a company like Saudi Aramco would completely, totally dominate any emerging markets index. Your diversified fund would basically just become a giant bet on a single state-owned oil company. So this rule, it's literally what protects your diversification. And what this all creates is a really powerful feedback loop. It goes like this. First, a company with a lot of freely traded shares gets into an index. Then, boom, trillions of dollars from ETFs and index funds automatically have to start buying it. This creates this constant, steady buying pressure, what they call a passive bid, that helps prop up the stock's price, which of course makes it even more attractive. It's like financial gravity in action. But it's often the case that when you solve one huge problem, you accidentally create a few new ones. And this system, while it absolutely prevents those crazy liquidity traps, it definitely has its own unintended side effects. It can distort the market in some pretty weird ways. So let's talk about some of these new problems. So what are the downsides? Well, first, there's what's called the exit problem. Now think about this for a second. If a founder sells a huge chunk of their stock, the company's free float actually goes up. And this forces index funds to buy more shares at the exact same time a key insider is cashing out. How weird is that? It also leads to this incredible concentration in the high-float tech giants, the Magnificent Seven. And maybe the biggest issue of all is that it creates a kind of valuation blindness. The system rewards companies for having shares available, not necessarily for being a great business or a good value. And that right there is the fundamental trade-off. The whole free float system, it's like a masterpiece of financial plumbing. It is designed to make sure the passive investing machine can run smoothly on a global scale, to make sure there's always liquidity. But it was never ever designed to figure out if a company is actually a good investment. And that really leaves us with this final thought. When you understand the rules of free float, it reveals a much deeper truth about the market. It shows us that it's not just some organic reflection of how we all feel about businesses. It's a massive structural machine that's running on a kind of invisible code. And once you can see that code, you'll never look at the market in quite the same way again.